Stocks closed lower on Wall Street Tuesday, breaking an 8-day winning streak for the S&P 500 index. The S&P 500 index fell 0.6% to 2,878.20. The Dow Jones Industrial Average dropped 0.7% to 26,150.58. The Nasdaq Composite slid 44.61 points, or 0.6%, to 7,909.28. The sell-off came as traders weighed growing trade tensions between the U.S. and the European Union and a report forecasting dimmer global economic growth this year. The International Monetary Fund on Tuesday cut its global growth forecast to the lowest level since the financial crisis, warning of significant downside risks to the world economy, including trade tensions, pockets of political instability, mounting debt levels, and increasing inequality. The IMF lowered its growth forecast for 2019 to 3.3% from the previous level of 3.5% in its latest World Economic Outlook. This is the third time in 6 months that the fund has revised its outlook downward. European indexes also finished broadly lower, giving up early gains after the U.S. threatened to impose $11.2 billion in tariffs on European products, including cheese, wine, and helicopters. On Wednesday, Asian stocks fell, also amid growing tensions between the U.S. and the European Union. Nevertheless, the losses were limited as investors digested the IMF updated forecasts fairly quickly. As such, the Chinese Shanghai Composite finished flat. Hong Kong's Hang Seng Index dropped 0.1%, while Japan's benchmark Nikkei 225 closed down 0.5%. In Europe, shares rose slightly on Wednesday as gains across most sectors offset losses among lenders, which were hit by a lack of detail in European Central Bank comments after the bank left borrowing costs unchanged. President Mario Draghi's comment shed very little light on reported plans for a tiered deposit rate and a new round of ultra-cheap bank loans. The Pan-European Stoxx 600 index rose 0.3%, and the general sentiment was capped by threats made by the United States earlier this week to slap tariffs on European Union-made goods. As for the currencies, the greenback was marginally lower against the majors. Market reaction post-FOMC minutes was quite limited as U.S. policymakers confirmed the patient stance recently adopted. Minutes of the March meeting released Wednesday showed officials see little reason to continue raising rates due to greater risks to the U.S. economy from the global growth slowdown and muted inflation readings that took more officials by surprise. At the same time, the minutes show officials didn't perceive any need to cut their benchmark rate absent a broader deterioration in the economy. The greenback was mainly unfazed by the minutes. Meanwhile, U.S. consumer prices increased by the most in 14 months in March. But the underlying inflation trend remained benign amid slowing domestic and global economic growth, which curbed the dollar's positive reaction to the release. The Labor Department said that its consumer price index rose 0.4%, boosted by increases in the cost of food, gasoline, and rent. This was the biggest advance since January of 2018 and followed a 0.2% gain in February. In the 12 months through March, the CPI increased 1.9%. The CPI gained only 1.5% in February, which was the smallest rise since September 2016. The euro-US dollar appreciated marginally for the day, but failed to challenge the 1.13% handle once again. On the downside, the 1.1230 area served as a short-term support. As long as the pair remains under the 1.13 psychological level, downside risks prevail. In commodities, Brent jumped to fresh 5-month highs, marginally below the $72 handle after U.S. data showing a hefty drawdown in gasoline stockpiles overshadowed crude inventories rising to the highest levels in more than a year. Crude inventories swelled by 7 million barrels last week, compared with analyst expectations for an increase of 2.3 million barrels. Gasoline stocks, however, fell 7.7 million barrels. Prices were also boosted by U.S. sanctions on oil exporters Iran and Venezuela, as well as supply cuts by the OPEC+. By the way, supplies from the OPEC dropped by 500,000 barrels a day in March to a 4-year low as Saudi Arabia continued to curb production. Also, the OPEC monthly report released on Wednesday showed that Venezuela's oil output sank last month to a long-term low below 1 million barrels per day due to U.S. sanctions and blackouts. Gold prices extended the rally for a third day in a row on Wednesday, with the bullion reaching the $1,310 figure after a break above the key $1,300 barrier after several attempts. The yellow metal was lifted by rising global oil prices and weaker dollar as the U.S. currency failed to receive a boost from the FOMC meeting minutes. Also, the bullion was supported by overall economic risks tilted to the downside as gloomy outlook has sparked immediate responses in safe haven assets, including gold. The fact that the International Monetary Fund cut its outlook for the global economic growth, the third cut in 6 months, lifted the safe haven gold as well. Amid a generally weaker dollar, the bullion could extend gains in the short term, especially after the break above the $1,300 psychological figure. The prices need to keep above this level now so that to avoid another retreat below the $1,280 handle. And And that is all for today. Thank you so much for watching. Please click subscribe to always be in touch with the latest market news.